Well, welcome to your exam 2 review for financial counseling. We have added on some additional modules, so always cumulative. We're doing modules 1 through 14. You have all of those slides, previous reviews to help. This time, put some thought into, this is a 15-minute class, it's Monday, Wednesday, Friday, instead of the Tuesday, Thursday. So half the short answer that you had last time, so less carpal tunnel. The rest is the same, the calculations, you could see some of the same calculations, but also up on the table is that employment consideration calculation where you look at the cost of living in one city compared to another and the salaries in both. In class, I talked about how in real life, you probably won't do that specific calculation very seldom for a client because there's so many online calculators where you can even go in and say, well, housing is covered, so take out the housing cost of this and some different things. But for the AFC exam, this is a calculation they have you do. Keep in mind that it's more than just, this place will pay me more, I'll have a better quality of life based on this salary. It's not just a single thing you're looking at, but that's all this calculation looks at. Is salary in one place, 80,000, salary in another, 100,000, and then comparing your purchasing power in those two places, which one's the actual greater benefit to you. Because there's all those other things that we talked about with employment, and are you gonna like it there, do you have family there, whatever other things you might have that might be of interest to you.
What was that calculation called?
The cost of living index, evaluating a salary from one city to another. So I'm going to skip ahead to some of the more recent stuff, and then we can come back to whatever you want to talk about. At the end when we have time. So I'm always open to questions, feel free to interrupt. All right, so newest topic, getting into here's how you use money, client. So different ways that we can bank, the reasons we want to have them in a bank, and we'll have a separate section later on where we go in depth into payday loans, check cashing outlets, title loans, and pawn shops. These alternative financial services that people that do not have banks use. The example I gave in class for where we're at now was the check cashing. I had a neighbor while I was in college that he was middle-aged, didn't have a high school diploma. He worked at a car wash and he didn't trust banks. So he would take his checks and he would pay to have them cashed, and then he would just have that cash to pay whatever bills he had, buy whatever food things. He's losing out with every transaction because he has to pay that fee. Where most banks will allow you to have a checking account for free, for no cost, meaning your checks, if you've got direct deposit, you can go directly there. That way, if you are sick, if you're out of town, if you're, for whatever reason, unable to make it to the bank to deposit your check, direct deposit goes in automatically. So better choice to do a direct deposit versus having a physical check where you have to do something to get it to the bank. It just delays the process and you don't have your money as quickly. So to save those fees, plus the bank is probably going to give you a small rate of interest. So your money can be working for you. Even if you don't have other investments, and you're just working out that savings account, checking account, you've got some money working for you. So you can teach your clients about banks if they're not understanding it or they're not trusting it. Here's what we can do. Here are these things in place to ensure that your money is safe. We talked about FDIC and the NCUA. So credit unions versus banks. Credit union, that's going to be under the NCUA. Banks under FDIC, Federal Deposit Insurance Corporation, where they're going to make sure that if you lose some money, if the bank goes out of business, if you lose money, if you get scammed or whatever, that's on you. And there are government organizations that are trying to help people not get scammed. But for the banks themselves, your dollars are safe as far as the bank losing money. So credit unions, you have to be some sort of member of that. Member of a community, an organization, whatever the limits are for that credit union. You may not qualify to be into a credit union in Pennsylvania if you're not a Pennsylvania resident or a resident of a certain county, or an employee of some institution. So they're gonna be a little bit choosier on who can bank with them, but they're not that choosy. Basically, wherever you live, if there's a credit union, you're probably going to be able to become a member of it. They tend to offer slightly higher rates of interest than banks. They are more focused on this specific community, where like a Wells Fargo is just worldwide, really. They're not worried about investing into any specific community. They're just offering these banking services across the world, more in the US than anything. I mentioned that deposit insurance, recognize these two differences. I think that was an issue on a quiz. FDIC for banks, NCUA for credit unions, they basically do the same thing. We have that $250,000 coverage per account. If I've got a joint account, could be spouse, could be friend, could be child, whoever, now I've doubled it up to 500,000. If I've got different types of accounts within the same bank, I can have 250 for each account. If I have another bank, 250 for that account. So this isn't like an IRA where I've just got my one annual thing. I can have as many IRAs as I want, but I've only got a single annual limit to split up among all of them. Same thing for our employer-sponsored defined contribution plans. Well, depending on the type, 457 is a separate thing. But 403B, 401K, one amount for the year, no matter how many I have, no matter how many employers I have. With these, it's per depositor, per insured bank. Varies by account, so I can have different types of accounts within a single bank. I can have multiple banks. I can have joint accounts, and I can raise my amount. And there might be a question where how can I maximize the coverage for a client with different types of accounts. Checking versus savings account. Checking, we have more ability to write checks, more ability to go to an ATM. We can have unlimited transactions within that account, deposits, withdrawals, and they typically look at this per month. So I can do as much as I want in a month versus a savings account where I'm gonna probably get a slightly higher rate of interest, but I'm not gonna have the same unlimited number of transactions. Depending on you or your client's needs, we might not care. So like my bank, I can have 6 transactions with USA per month out of the savings account. That's probably more than I need. I do it where I have that online bank, and then, well, USA is not even brick and mortar, but you might have a brick and mortar bank, so you can go in and get things notarized, you can talk to somebody, you can work through whatever and have that relationship, and then have an online bank that typically, because they don't have those same costs of, paying the heating and bills and having all these different locations, they can offer a slightly higher rate of interest on those accounts. So savings account is where you want your paychecks deposited, and then maybe once a month, you transfer some dollars into your checking account to cover whatever your monthly expenses are. Money market accounts, these are going to be through Vanguard, Fidelity, wherever you want to go, and they are going to invest all the dollars, all their people's investments into T-bills, into CDs, into all these different ways where they're going to earn a little bit of an interest. So money market accounts used to offer better rates of return than checking savings accounts. They probably still need checkings accounts, but savings accounts currently tend to offer a better rate of return than the money market account. The idea behind the money market account is to maintain your purchasing power. So we've got inflation eating away at our purchasing power every day, every month, every year. So we invest these dollars, they're very liquid. I can pull out those dollars anytime. Good place for emergency funds, Same with the savings account, as opposed to like a certificate of deposit. Here, I'm locked in for a certain period of time unless I wanna pay a fee to get it out early. So I can still get those CD dollars, but if I need it for whatever reason, I'm gonna have to pay a fee if I can't keep it there for the 6-month term, the 1 year, the 5 year, whatever the CD's term is. If I am gonna do something like that, a bond might be a better idea. The bond is going to allow me to, let's say I've got a 5-year term on the bond, so I lent this company, this government $1,000, and they're gonna pay me back $1,000 at the end of 5 years. In the meantime, they're gonna make these coupon payments, the interest payment to me for lending them the money. If I wanna get out of a bond, I can go out in the open market and I can sell it to somebody else. Now, there's risk, it might not be worth as much because rates have changed, but I'm not paying a penalty for selling it, like I would with the CD if I needed those dollars. Emergency fund, so there's certain things that are gonna happen in life. You need to pay a deposit for your homeowner's insurance because a tree fell on the roof. So I'm paying my premiums, that's an expected expense, that's not an emergency. But suddenly there is a tree that falls on the roof and I have to pay this big deposit in order for them to fix the roof, to get that insurance coverage. So I'm paying additional dollars. I'm sorry, not deposit, deductible. So I'm paying a larger deductible for that. I can balance that out, higher premium, lower deductible, lower premium, higher deductible. The emergency fund is to cover things like that, or things that aren't insured. Maybe I have a blowout on my car. I need to replace the tires. I need to buy a new battery. Things that I might have car insurance if I've gotten in a wreck, but it's not gonna cover me needing new tires or whatever types of maintenance things that are gonna happen. So the idea behind an emergency fund is, what if, those unexpected expenses arise, I can take care of that, but what if I just completely lost my income? Could I maintain my exact style of living right now? So without foregoing any of my budget, how long can I last? And we look at 3 to 6 months for an emergency fund. In reality, really, I'm not gonna keep spending like I had a paycheck. I'm gonna start dining out less, buying different groceries. I'm not gonna get the steak. I'm gonna get the ramen, the noodles, the beans, things that are gonna stretch my budget so I can last a little bit longer. With that, once I build up the emergency fund, then I can start looking at, well, now how do I invest? How do I do some other things? And I can do both things at once. If I have that 5% match from my employer for a retirement account, I wanna take advantage of that. So I'm putting my 5% in to get the 5% match, doubling up my dollars, and I'm putting aside some dollars to build up the emergency fund. Once the emergency fund is built, cool, now I can put those dollars into retirement or wherever else they need to go. Taxes. So you had your first exam in tax, and second exam. So, huh?
I'm at, I didn't hear what they said. So I was just gonna say Tuesday and Thursday, I think, first week.
So, same timing-ish. You should be, for the most part, experts in tax now. We covered the things that you would have there. Remember that as a financial counselor, you're not filing taxes for them. You can educate them on taxes. You can help them understand, hey, maybe you should take some deductions. Maybe you should go with the standard deduction. You can help them understand some things, but you're doing that external referral to a CPA if they need it. What was the sort of scam I talked about with taxes? You go to H&R Block, you pay them to file your taxes, and they say you've got a refund, and then what?
Oh, you get it early.
Yeah.
You lose some money.
They'll say you've got a $2,000 refund, I'll give you $1,800 today, and that way you don't have to wait. So you just gave up $200 because you couldn't wait a week. Understand the elements of a tax return, so just big picture, it won't be as in-depth as your income tax courses, but you should know AGI, taxable income, refunds and credits and deductions. Looking at red flags, and you might ask for some previous years of tax returns to kind of get an idea of where they're at. You definitely want that as a financial planner, looking at their whole financial picture as a comprehensive view versus a counselor who might have these specific things they're looking at. So you might not always be looking at a tax return for a financial counseling client. Looking at, especially if they are self-employed, we'll talk about our different types of employment. If they're self-employed, we want to make sure that they are setting aside dollars to be able to pay taxes because they don't have those payroll taxes taken out like they would if they were an employee of a large company, that W-2 employee. Potentially adjusting withholding, and we might be able to do that mid-year. They had another baby, we've got another mouth to feed, so we can put that in for their W-2 employment. We can file and let them know, like, okay, we have another child, so I need more dollars, basically. Different things change with marriage or divorce, or your spouse passes away. You've got different ways that you can file taxes. So if you're single, you're filing single. But if you are single after being married, there are some potential choices there, depending on how that marriage ended. If we've divorced, we've got our one final return in that year. And if we are widowed, we have different ways. And so it depends if we have children too. We've got head of household and some other things that we can file after being widowed, or if we have children. So we want to make sure that they are doing the correct one and understanding the benefits or withdrawals. It's rare that you would want to do married filing separately. You usually want to combine them so that you're able to take advantage of additional deductions.
What would be like an example of, so like, not necessarily like an event that would cause you to withhold or adjust your withholding, but like, what is like the withholding process like actually look like?
It's just a form that you would fill. You'd give it to your employer. They would file it with the IRS, and then the IRS would be like, okay, James, you have 3 kids now instead of 2. So that's 3 dependents, maybe 4 if we're counting the spouse, but you've got another dependent.
Okay, so it's just letting the IRS know that you're
Letting them know, and then that's gonna change how much taxes that they're gonna charge you, basically.
Okay, gotcha.
Charge you per paycheck, but you still have to pay them at the end of the year, depending on what you withhold. So you look like a 1 or a 0, and I think 0, you take it all out, and then your refund or due at the end is less. But if you put 1 or something like that, you pay less at the time, you have to pay more come tax season.
Yeah.
Potentially.
I think that's how, I don't know.
But yeah, so like the number is, this is how many dependents I have. So if I have 0 dependents, then I'm fine. But if I'm adding more dependents to it, I've got 1, I've got 2, I've got 3, now I get more money. Or they don't take as much money out of my paycheck.
So wait, you're like, what tax would be taken in? Like not your employment tax, your employment tax would be affected by it, right? It'd just be like the income tax that's withheld?
So there's the withholding of dollars, and at the end of the year, they'll give it back to you, or not, depending on what other things you've got going on. But it's looking at how many mouths you're feeding, basically. And the
Okay.
more mouths I'm feeding, the more money I should be able to keep.
Okay.
Other things, mortgage interest, we can deduct that interest and making sure that they're actually tracking that. If their bank should give them a statement and educating them about that. medical expenses, if we have a lot of medical expenses, we will talk later in the semester about how medical bills are an easy one to potentially get reduced just by reaching out to the hospital and saying, hey, can I get an itemized bill? What if I pay in cash? Or can I create an installment plan? So easy ways you can simply do it there. If it's a 501c3, a charity hospital, which a lot of them are, if you're low income, they're gonna provide a low cost or no cost. Some of the things will basically disappear. Guess we haven't gotten into health insurance yet. Well, no, we will, because we talked about the employment. I'll talk about that in a second. Other ways that we can save our dollars, flexible spending account and health savings account, we're gonna choose one or the other. We may not have the choice for the HSA, you have to have a high deductible health plan. But the difference between the two, if I do have the choice, flexible spending account, I am promising to put dollars aside with every paycheck throughout the year, and I can immediately spend those dollars, even though I haven't put them aside. So that's a planning thing for your client. They know they're gonna have these medical expenses coming up, and they know that they're gonna leave this job soon. Well, if I put in that I'm gonna maximize my FSA for whatever it is for the year, let's say we put $5,000 in there, I can say I'm gonna put $5,000 in there, and it's gonna take out of each of my paychecks over that year equally, January through December. So I know I'm going to need this surgery, or I know that, let's say I'm pregnant, and I'm gonna give birth in January, February. I can plan that ahead. That's gonna be a big expense for health. FSA, I say I'm gonna put this much aside in it, and then after I pay that bill with my FSA, I leave and go do another job, or maybe I wanna be a stay-at-home mother and stay with the kids for a while. But I can spend those dollars before I actually put them in. The employer eats that cost. I can go to another employer, I can start a new FSA. Cool, I'm not charged for any of those dollars that I spent, even though I didn't fund it. But if I don't spend those dollars, at the end of the year, the FSA is use it or lose it. So come December, maybe I'm buying, like I told you, those little first aid kits to make stocking stuffers, something like that, where if I don't spend these dollars, they're just completely gone. With the HSA, the advantage is those dollars are not gone, and I can invest them. So the FSA, it's just dollars set aside that I can spend in an account, where the HSA, I am putting pre-tax dollars in, they're grow tax-free. At 65, I can spend it on whatever. Before that, I can spend it on medical expenses without a penalty. With the FSA, those dollars gone. Employers typically make money on FSAs because most employees will have a few dollars left over, 100 here, 200 there, and it just goes to the employer, and they can do whatever they want with those dollars. With the HSA, those are my dollars. They go with me when I leave, but I can't spend in advance. But I can invest them. Usually employers with an HSA will, here's your HSA, and we're going to just invest it on your behalf. By default, we're gonna put it in something super, super conservative, maybe like a money market, and you can choose, maybe not through the place that they put the money. I can't for the University of Alabama, so I transfer mine to Fidelity. I just created an HSA account with Fidelity, hold my HSA dollars over there, and now I can choose how to invest them. Young and healthy, or just healthy, HSAs are great because I can have all that tax-free growth. Afterwards, you get married, you have some kids, cool, you still got the HSA, but maybe now I don't want to be as risky with my investments. So thinking about where you are, your risk tolerance and risk capacity. Kids get sick, they need braces, they break bones. Retirement accounts, we've got tax deferred with the traditional IRA outside my employer, and the 401k, or the 403b, 457. We also have Roth options where it'd be tax-free. So tax deferred or tax free. Combined, we call them tax advantaged. So picking which way is best for you. Riskier stuff in the Roth, because I expect a greater return if I'm taking on the greater risk, and if it's gonna grow more, I don't wanna pay taxes on it. With those tax deferred, my tax today is reduced, but I'm gonna pay ordinary income on everything that comes out. There's usually gonna be some sort of match with the 401k. Yes?
I mean, interrupt you, I was just curious, like, it feels like when you're younger, like, a Roth just makes more sense, cause where your, like, marginal tax rate is, and just like the investments that you'd be making probably, I mean, realistically, you'd wanna have, like, more risk, just cause higher, or it would make sense to have riskier investments earlier on, I would think. But at what point would it be an advantage to, like, is there kind of a benchmark where you'd be wanting to fund or contribute to a non-traditional IRA rather than a Roth IRA based on your income, based on where you are from a marginal tax standpoint?
So I'd say there's not a rule of thumb, and one of the things you said, so yes, absolutely, when you're younger, Roth is great because time value of money, it's growing tax-free. I wanna get those investments in early as possible, so invest early, invest often, that dollar cost averaging. Roth is great, especially when you're young, but your tax rate is probably gonna be lower when you're younger. So I'm not saving as much in taxes, now compared to later. So the idea is my income's probably gonna go up, and then maybe it's more advantageous to do the traditional because it's reducing my income now, and when I retire, my income might be lower, so the tax rate might be lower. What we're gambling on is what our tax rate's gonna be in the future. Those can change. Right now, they're lower than they have been. We've had much higher tax rates. Some other countries, you know, you're paying 50% plus, where here, that would be very unusual. But if you go back to, I wanna say the 70s, the 60s, we had higher tax rates.
Over like 37, like.
Yeah, I'll look it up. I'm not sure what the years were, but there's a table, I think I do in investments, where we look at what tax rates were over time. No, I do it in retirement planning. But we look at tax rates over time, and we're lower now than we have been, where it was much, much higher. I just can't remember the years it was that.
No, you're good.
It was before I was really worried about paying taxes.
Yeah.
There's also this idea of tax diversification, where I have a mix. Here's the taxable brokerage where I get capital gains, there is the tax deferred where I'm gonna pay ordinary income, and then there's the tax free where I'm not gonna pay taxes on what I take out, assuming I'm taking out qualified distributions for both, otherwise there's a penalty. And with the Roth, I can always take out my own contributions, so first in, first out, I take those out without paying a penalty. But all the growth, all the investments, once I get into that, then I'll be paying the 10% penalty. With the traditional 10% plus ordinary income. Small employers, the SEP and Simple IRA basically work like a traditional IRA, but they allow you to put more dollars aside. So we have an increased limit, and it's not gonna count against my individual. So I can still do my individual IRA, and then my small business, I can create one of these. I'd say if you're gonna do a simple IRA, you might as well do a simple 401k. It's just a little bit more work when you get more dollars into it. More full-on 401k. Already talked about the Roth. Specific ones for college, we've got our 529 plans that allow you to, and grandparents and whoever else, to contribute to some child's college fund, and it can grow over time. Roth gives more flexibility to pay for college without penalty, but it also means that once the child turns 18, that account is theirs to do whatever they want with. So the 529 would be restricted to just education funding, but I don't have the same flexibility. So a child gets a scholarship, well, okay, all school is paid for, maybe they're gonna use some of the 529. I could give it to a sibling, to a cousin, but if I don't have a sibling or cousin, it's not as much of a benefit. I still can get my money back, but it's not gonna be as big a benefit as if it was for school. Bonds, going back to your idea of the different taxes of different accounts, I wouldn't wanna put a municipal bond in a Roth, because it's not serving me any purpose. I'd wanna maybe put it in a taxable account or a traditional IRA, where I'm paying more in income later. Talk about the primary residence. We've got different definitions on primary residence that allow us to say, I lived in this home for 2 of the last 5 years. It was my primary home. It wasn't my vacation home. It's where I lived. And then I sell it. I can exclude some of the growth on that. Employer benefits. They may offer daycare for children. They may offer, you'll talk more about this in retirement, but maybe a Metro card in New York or Chicago, where you can receive that. It doesn't count as income to you. The employer is able to deduct it. In Denver, you typically would get a Metro card and maybe parking if you worked downtown, where you didn't have to pay for that. The employer was, but it wasn't counted as income to you, so you're not paying taxes on it, and you're not having to buy that public transit, whatever. Deferring income, so we can potentially choose to take something in January versus December. So just shifting when we receive it based on our tax needs for that year. Sometimes you can't, sometimes you're forced to, like, well, no, you're getting it in December. But if you can, you might be able to, hey, employer, give this to me in January because of whatever tax situation, it'll be more advantageous for me to get it then. Know when taxes change. So we talk about legislation changes causing differences in how you might invest. Same thing for taxes. There's only so much you can do with taxes, so you are kind of limited there. With investments, I've got greater freedom to invest wherever I want, where I'm employed, I might not have an option to receive certain things. I might not be getting some of those taxable retirement accounts for highly paid employees. Filing and penalties, if I don't file on time, so you've got a late filing penalty and a late payment penalty. So October 15th, we could have, instead of paying April 15th, we could have said, I want to file an extension and pay October 15th. Cool, that's automatic. You just send the paperwork. Just like if I have that tax debt, automatic, I just give them some paperwork and say, hey, I can't pay, or can I work out an installment plan, and you can do that. But we want to make sure that we do file, even if we can't pay, because then we don't pay as much in penalties. So I can file and say, here's what I owe, but I can't pay, and I'm gonna follow that up with, here's why, can I do an installment plan, can I do something else, to try to minimize the cost to me. And I can maybe even negotiate and say that instead of the $40,000 I owe, how about I pay $30,000 because X, Y, and Z, and they might accept it. So the government has more powers than anybody else that you would owe money to. They can garnish wages, they can go into your bank account, they can take tax refunds, they can take Social Security, they can take away your licenses to be a beautician, to practice law, to be a doctor, if you don't pay them. So stronger motivations to pay the government, but at the same time, they also have these built-in things for you to say, I'm broke, I can't afford it. Just file some paperwork and you can get a timeout. You may still pay interest on it, or we can set up an installment plan. You just have to communicate and work through it. Versus some other lenders that don't have those cut and dried, all you have to do is say you're broke, all you have to do is file some paperwork. They may not care. Bankruptcy is probably not going to take away most government debt, but potentially. Tax refunds, we talked before about how you start a job. I'm not gonna miss dollars out of that first paycheck because I never had them before. So college students, you get your first job, immediately sign up for the retirement plans, for the different things, put your dollars aside for the health insurance that you need, all those things, and your first paycheck will be like your second paycheck, your third paycheck, your fourth paycheck. If instead, I don't start putting those dollars aside into retirement until my 5th paycheck or until after a year when I start realizing it, it's gonna be a hit. I'm gonna think, man, I used to be able to spend all these dollars, I had so much money. It seems like you have less, but really you're saving for the future. And you want that time value of money working for you, compounding your dollars having them work for you. So tax refund, kind of same idea. These aren't dollars that you're gonna miss because you didn't have them. This is sort of a bonus. So treat it to, pay off that credit card, build up your emergency fund if you didn't have it. Look, whatever the issue is with the client, here's some dollars that we can put towards some positive goals rather than let's go party. Tax avoidance versus tax evasion. Tax avoidance, I don't want to pay taxes, so let's strategize and figure out how I can get my taxes lower. To go back to James, why might I want a traditional versus a Roth option? I might also want to reduce my adjusted income because I want to say, hey, I'm on this income-based repayment plan for student loans. We'll talk about student loans more our next class after the exam. But if it's income-based, I'm putting aside dollars for my future and I'm reducing my student loan payment. Illegal, hiding income, hard to do if I've got that employer W-2 income, but if I'm a contractor or I work with cash, easier to do. We don't want to do that. That's how they got Al Capone. Okay, employment considerations. So different places we can get paid, different ways we can set up those payments, and understanding what's on there. Unemployment, basically, I'm gonna get paid because I got laid off. And then I've got part of my COBRA to extend health insurance. Evaluating job offers, that would be the math you might get into. So different ways we can get income. Most common is gonna be full-time. I work for this job where I get health insurance, I get a retirement plan. Part-time jobs, you probably won't get health insurance. You probably won't get retirement plans. You might have clients that have multiple part-time jobs where they may be working 60 hours a week, but they don't get these benefits. So for retirement, I can invest in an IRA, Roth or traditional. So I can still help them figure out ways to save for retirement. Health insurance, we've got, so still until 2026, we've got the Affordable Care Act where they can get insurance to cover different needs. If I'm self-employed, now I need to make sure that I'm setting aside dollars for taxes at the end of the year because I might not be able to have those payroll taxes deducted down. And really, if I'm doing this smart, that's an advantage because the government does not pay me any interest on the dollars they take out. So January paycheck, they took some money. February, they took some money. Every month, so I get paid monthly, the government is taking some money out of my paycheck. If I were self-employed, I'm gonna owe that money at the end of the year. So I'm gonna owe those 12 months worth of small little things taken out, but I could have just been setting that aside into a savings account where it's earning interest throughout the year. But then I may not have, it's gonna cost me money to create that simple, whatever retirement plan if I wanna do it through the business. Where with the 401k, that's a cost that's kind of eaten by the employer. Seasonal causes budgeting issues because if I'm not working, let's say I've got a landscaping business, maybe we don't do as much work over the winter, over the colder months, and I've got to save for those months. If I am in maybe sales where I get a big commission one month, but it's going to vary the next month, that's going to be another thing I got to help figure out budgeting, so not necessarily seasonal. Gig work, Uber, DoorDash, something like that, where you are controlling your own hours, which is great for scheduling, but I may not have all those other benefits. Talk about that. Talk about health insurance, retirement, and FSA, HSA. If I do have health insurance through employer, I'm gonna get to choose and think of cafeteria. In junior high, elementary school, I want the potatoes, I want the peas. I get to choose the different things I want. There's some things that I'll just get, like I get life insurance for free. I say for free, nothing's free, but it's not something that comes out of my paycheck from the university. So I get a life insurance policy. I can decline health insurance coverage if I wanted to. So say you got a client, you got a spouse, we're gonna look at both their health insurance options through their separate employers and figure out which one's better. If they work for the same employer, well, I definitely don't want two of them. We're just gonna pick one. And that means that I'm not paying for two health insurances. I'm picking whichever one is best. This one's better for having children. This one's better for having no children. Client has no children, we're going with the one with no children. And we can switch next year if things change. So I'm choosing what I want. Medical, I can choose how much I want my premium to be, which means my deductible is gonna be higher if I pick a lower premium. But if I'm healthy and I don't anticipate any major medical expenses, I'd rather keep more dollars for me. If I have children, if I have poor health, I might wanna pay the higher premium because I think that's gonna save me money in the long run. So it's figuring out what's gonna be best for you or your client. Dental, I pay a little bit for dental and I get 2 free visits a year. Vision, I opt out of because my eyes are good and I can pay for that out of pocket if I need things. Retirement, you may have some choices. Most employers are gonna offer you a 401k and a defined contribution plan. I can choose how much I put into that. They may also offer a Roth 401k and I can divide my dollars between the two, however I want it. Yes, sir.
What's the percentage cap on a 401k that you can put in?
It's not a percentage, it's gonna be a dollar amount.
It's not like a percent of your income?
I can't put more than 100%.
Oh, yeah. You can put, really?
If I could afford it, yeah.
Uh-huh.
Well, so there's those 2 limits. I can't put more than 100% and I can't put more than the annual amount for the year. And what is that, like 23,000 with additional dollars if you are older. So
The catch-up.
the catch-up.
Gotcha, thank you.
But yeah, so it's not a percentage, it's that dollar amount, and when you get into retirement plans, there are some rules, basically making sure that those higher compensated employees, the key employees, are not, well, there's 2 different things, highly compensated employees, HCD and key, KEY. Highly compensated HC2 rules, where they're making sure that those employees aren't getting a bigger benefit out of it, which can be a problem if you've got a lot of low-paid employees where I can't afford to put more than like 2% into this retirement plan because I gotta live, I gotta buy groceries. That's for retirement planning, but yeah, there's a cap. And that's gonna be across all 401ks, just like all IRAs. I've got my one 23,000 I can put in, no matter how many 401ks or employers I might have.
Do you see, like, Social Security, like, you know, people are saying it's not gonna be around, do you see it going into something like a 401k type of ordeal?
Maybe. I think we could have invested it differently. We invested very, very conservatively, where if it had been even 50% in just a S&P 500 index fund, and then the other 50%, the more conservative that it is now, we'd be okay. But think of it, it's built on the employees, people that are working. So younger are supporting the older. So if there is a constantly growing population, then cool, there's always more, because you know, everybody has 2 children or 3 children, then there's gonna be enough people to support it, assuming they stay there. But we're having fewer children. And at a certain point, you couldn't keep having more and more children because the population wouldn't fit, the land mass would be able to support it, whatever. I think we're far, far away from that, but there's a lot of land resources everywhere for 10 times the population or more, where we've got all that. But Social Security, I see the change more likely being we make the ages older. When it first was created, the idea was to die with dignity, and people would only live like a few years. years after receiving Social Security. Like lifespans were not as long as they are
So
now.
now they're living longer, so it's easier.
We live longer and we're more active in our retirement, and costs have gone up.
Makes sense.
So we've got more things going, more years to spend on the retirees and fewer workers paying into the system. So I see that extending the ages, so now maybe like 70 would be the earliest you could claim, and 75 to 80, where it just kind of shifts up in life. We already have a few brackets like that, where it used to be younger, and now it's a little bit older depending on when you're born, so like 1960 and after is where I'm at, and you would get, I could retire at 62, but I'm not getting as much. So I see them shifting and shifting for,
Is there a phase out? Isn't there like, is there a phase out with how much? Because once you make a certain amount, right?
yeah, so there's a Social Security cap, and dollars beyond that would still go into Medicare. So let's go into, here what's taken out. So 6.2% Social Security, up to whatever that cap
That's
is.
right.
The last I remember is 136.8, but it's definitely gone up since then. I think 152, 160 or something now. I haven't taught retirement in a couple of years, so these things I used to have memorized. But dollars beyond that would not go into Social Security. So you're paying less into Social Security, but you're still paying the same amount into Medicare. So all dollars are taxed for Medicare, only up to the cap for Social Security. What is it?
How does that work? How do you do that? Thank you.
So they're taking those dollars out. Have your emergency funds. If we anticipate layoffs, if we anticipate losing our jobs, make sure we're ready. You can help them with a resume, updating that to highlight the things they need. There's a weird trend now where I see like pictures, like if you try to go to a template for a resume, there's like a profile picture, which I think is weird for hiring. Bigger in other cultures. Certifications, so different ways we can get certifications. LinkedIn has some free ones, the library, different ways where we can get free things to improve our earning potential and show on our resume that we have continued to learn to grow. So I got laid off. Unemployment insurance my employer has been paying. I didn't pay that. The employer paid into the state of Alabama, the state of Texas, wherever we are. I get laid off, I go to the unemployment agency, say, hey, I got laid off. I was a worker, they're gonna look at my work history, make sure that I didn't punch my boss in the face and that's why I lost my job. But if I was laid off, or I was essentially fired, quit, forced quit, basically weren't scheduling me for shifts, or they drastically changed, I was remote and they changed the conditions of employment to now I have to drive an hour to get to the office and I gotta do that 5 days a week. So there's other ways that we can get it. And I'm gonna get paid for a certain period of time depending on how I left that job, as long as I continue to look for a job. COBRA allows me to continue receiving health insurance, but now instead of the employer subsidizing some of that, I'm paying up to 102%, that additional 2% going into the admin cost for whoever's supplying that health insurance, because the employer's not paying it anymore. Before that, I was probably paying 40% of the cost. SNAP to get food banks, places like that. Let's go into the math real quick. So cost of living different than other things. Big picture, we want to look at the total package. This is math you wouldn't do in the real world, but we would do here. It's not. So the calculation, salary in one place times the cost of living adjustment in the second place divided by the cost of living adjustment in the first place. We did a different calculation earlier this semester. This is the one that the AFC uses. So they'll get you similar answers. This is going to be the one I'll use on the exam. This will be the math you got to do. Easy math, you don't need a financial calculator to do it. but the idea is here, that should be there, 100,000 times 1.495, this is 1.495, gets me 149,000. So I would need cost of living one, Dallas, to New York City, I would need $149,000 in New York City to be equal to what Dallas is. Got our credit cards, what time is it? Are we over?
It's not 50 on the dot.
9:50. All right, well, remember your credit card stuff.
Can you go back to that, last slide, the cost of living? So, for the adjusted salary, if you're taking like city one and then applying, like, that just tells you how much you would need to live in city two, that give you the equivalent.
Yeah, exactly. And I could have picked either way, like I could have called New York City, City One, and just, swapped the numbers. Yes,
You gonna put this on whiteboard?
it's already on Blackboard.
Okay,
Yeah,
look, yeah, look, I think you might have put the first test on under the exam too. I might be wrong, I don't know what.
First review.
Or yeah, the first like exam review.
Okay,
for exam
sorry
two.
about that. All right, so
Okay,
I will
yeah.
replace that with these slides, for the exam two, and this recording will be up as fast as it goes. Sometimes it takes 8 hours, sometimes it takes 8 minutes.
Yeah, that sounds good.
All right. Roll back. Thank you.
Wait, that's like, you need 150K in New York City to live as comfortable as you need 100K in Dallas.
I made up those costs.
But like, for example.
But yeah, that's what
Yeah.
that's saying. Better to use those cost of living calculators online.
Yeah.
They'll take more into account. I want you all to be ready for the AMC exam.
Usually salaries adjust for that, but not as much as it should.
I was looking in law school. The big law firms